Go back and look at 1979 to 1980. Gold went into explosive mode. That's when silver really went berserk, late in the bull trend. Always in the latter part of an aged bull trend that silver suddenly got its guts together and beat gold. So in other words, it wasn't an ongoing process all during the bull trend where silver beat gold. That wasn't the case. Silver would mess you up all during that time. Gold would dip a bit, silver drop more. And so gold go back up, silver go back up some. But it wasn't until late in the bull trend, and I think that's the phase we're about to enter, where the more ballistic move starts to occur. And that's when I think silver, and especially the miners, will suddenly begin to outperform gold in a big way.
Silver and gold have exhibited notable volatility in their market performances this year. Silver showcased a 6% year-to-date gain in the domestic market, while gold, experiencing extreme fluctuations, has steadily climbed with an 11% year-to-date increase. November witnessed a marginal rise in gold prices alongside a significant 2% surge in silver, aligning with the upward trend observed in industrial metals. Silver maintained a stable price until mid-November before experiencing another notable spike, triggered notably by remarks from U.S. Federal Reserve Chair Jerome Powell, alluding to potential rate cuts. Despite falling short of its year-to-date high set in Q2, silver peaked at $25.48 on November 30th. Recent activity in the silver market indicates a current preference for concentrating on gold rather than responding directly to the slowdown in the U.S. economy, challenges in Europe, and a relatively tepid recovery in China. Notably, 60% of silver's demand for fabrication arises from industrial uses, underscoring its dual nature as both an industrial and precious metal, contributing to its heightened volatility. Nonetheless, in recent years, it has become an increasingly vital portfolio diversifier, particularly alongside gold. Over the past 5 decades, the relationship between silver and gold prices has fluctuated, ranging from 1.1% to peaks of 6.5%. While hitting 6.5% was infrequent, peaks in recent decades consistently hovered around 2.5% to 3.5%. Michael Oliver, the creator of momentum structural analysis, suggests that if silver were to regain its position at 2.5% of the price of gold, even at its current value, it could foresee a substantial surge. He draws attention to historical bull markets in gold, emphasizing an 8-fold increase from lows to highs. If gold were to replicate a similar leap, reaching $8,000, and if silver adhered to its typical pattern, reaching 2% or 2.5% of that price, silver could reach several $100s per ounce. Michael contends that this scenario isn't implausible, drawing insights from past trends where silver has notably accelerated in the later stages of bullish trends. Stay tuned for clips from Michael Oliver's interview with Andrew Maguire. But before we proceed, if you're eager for more content like this, please hit the subscribe button and turn on notifications for updates. Thank you, and enjoy the video.
Now, there's a way that we measure that. And like you're looking at the ratio between silver and gold, we do it a slightly different way. We measure a price of silver divided into gold as a percent of the price of gold. So right now, for example, silver's worth about 1.1% of the price of gold. Over the last 50 years, if you measure that relationship, it's been as high as 6.5%. And okay, we'll take that and exempt that. That was a rarity. But all the peaks over the last, let's say, 20 years, it keeps coming back up to 2.5% to 3.5% of the price of gold. It's almost routine. It's not, in other words, it's not an aberrational level to go to. Well, if we're at 1.1% right now, the price of gold and silver went up to 2.5% of the price of gold. Even if gold were just here, silver would explode off the page. But see, our assumption is gold's going to probably and possibly outdo this. But the prior bull markets in gold over the period span of 10 years, the peak in 1980, for example, the peak in 2011, were like 8-fold plus. Okay, well, we started from a low at $1,050. If gold has another 8-fold move, which would be sort of like, oh, I did it again, would be $8,000 gold. And for the factors I've been discussing, the stock market paper implosion, illiquidity in the bond market, gold could easily do that. It's got the fundamentals out there to do it. And I think it's got the technicals. But if gold went to 8,000 and silver went to 2% of that, or 2.5%, again, which routinely, if you look at a historical chart of that spread relationship, it's done it so many times, it's almost like, no big deal. Well, silver would be a couple $100 an ounce. Okay, so I don't think that's outlandish to expect that. And again, our examination of the prior bulls was that that occurs, that sudden wake up by silver occurs late in the bull trend and it goes berserk. Poor man's gold. Okay, I think that'll occur again. Now, what we measure though is not only do we plot that spread, where's silver closed this week in relation to gold? Oh, it's 1.13%. Okay, we plot each week or each month, and you get a chart. And that really is sort of a price chart because we're measuring price versus price. Okay, but we also run momentum studies of that price action. And they give you a slightly different picture. In other words, what you look at on the spread chart, you say, gee, if we just get up to this level, it's breaking out. We look at momentum, and I'll throw out a number for you. Right now, we're 1.1 something. Silver, the price of gold, 1.1%. 1.3% will break out momentum big time of that spread relationship. So, for example, back in the 2020 surge, gold went from a pullback low in March of 2020 at 1,400, got up over 2,000. So nice percent move. But silver doubled. So the silver spread to gold exploded into 2020 and didn't peak till 2021. Silver was about $30 at that point. Still at its highs, gold wasn't quite. But the spread peaked then. And since 2021, that spread has done this staircase down, not collapse, just arm wrestle its way down where you could draw a channel. But it says right now, all you have to do is get back up to about 1.3% and game's on again. In other words, silver's likely to then reassert itself versus gold. Same thing happened late in those two prior bull trends. You could have plotted the spread relation between silver and gold, and it alone would have told you we're about to go accelerated mode. Not just in the spread, but in the net price of both metals. So I think what you need to watch for there is the spread relationship between silver and gold moving up to about where silver, an ounce is worth about 1.3% the price of gold. At that point, it's helmet time. I think we're about to engage the dynamic phase.
Gold is currently surging to record highs due to a recent dip in bond yields, a weaker US dollar, and heightened geopolitical risks. Michael has highlighted the evolving relationship between bonds and gold over the past year, noting a partial separation in their correlation that hit a recent low point. He observes that while gold initially hit bottom in the 1830s during the second week, it wasn't until the second week of October, trading in the 1860s, that a signal hinted at the reversal of the decline in gold. Bonds did not immediately follow suit. It took a few more weeks, with a significant drop in price, before aligning again with gold's movements. This deviation marked a phase where gold trended upwards without a simultaneous increase in bond prices. Despite a potential short-term rally in bonds causing yields to drop, it should not be construed as a long-term trend. Even if the rally continues for a few more months, it is unlikely to sustain itself as a consistent upward bond trajectory. Let's get back to the interview.
The linkage between bonds and gold, which had been almost week by week over the prior year, divorced itself to some extent at the recent low. When did gold bottom? In the 1830s? Second week, we got a buy signal. Second week off the low in October. It was trading in the 1860s. We put out a buy signal saying, okay, that process of decline that had been underway since early this year was over for gold. Bonds did not turn up then. It was 2 to 3 weeks later and much lower in price. Bonds finally said, oh, okay, I'll join you again. So the linkage started to get a little sloppy there. Gold went up without seeing the bonds turn up. Well, now yields are starting to drop, and we're not bullish on bonds. We examine things primarily through momentum structure. In other words, when price chart guys look at a price chart, they're looking for what's called structure. Uptrend lines, floors that they can define, ceilings, and so forth. They plot those on their price chart. We do the same thing, but we do it with momentum metrics, because usually momentum will turn before price does. And right now, our long-term momentum assessment of bonds is nice rally. Yep. Yields are going to drop some. Yep. Don't expect it to sustain. The rally will go maybe a couple more months. Might be enjoyable, but don't get married to it. It's not a long-term rally for the bonds, I don't think. In other words, yields aren't going to continue down. But I think that's the context that gold's been looking at for the last 3+ years. In other words, it got up over 2000 in 2020, dropped back down into the high 1600s, got back over 2000 again in 2022, dropped back down this time to the 1600s, taking out the prior lows. That got everybody bearish, not us. We said it's a bear trap. Then what did you do early this year? Back over 2000 again. And again, the price chart guys with their rulers and crayons sold at 2050, 2050, 2050. Never to want to touch 2100. That's their risk. And they got to pull back into November, back down into the lower 1900s. And then we blew through that ceiling. 2100 was the breakout level in terms of price. And what's happened since is, to some extent, to be expected, gold blew through that level in the dark Sunday night, U.S. time, a week ago, not this Sunday, a week before, and went from 2100. And I knew, just looking at the price chart, and any price chart technician could know, God, there got to be a lot of buy stops starting at 2100. Both the entrenched bears who've been selling 2050, 2050, 2050, and longs who said, oh, golly, I better join in. And so they no doubt hit in the dark an illiquid time. But the other thing that I think is really influential to gold and also influential to the Fed, the U.S. stock market. Unlike most stock markets in the world, you can look at Shanghai Composite, you can look at Europe. They didn't do anything like what the U.S. market did from its 2009 low to its 2021 high. S&P went up 7-fold. NASDAQ 100 went up 16-fold. And we called a top in January of 2022. We said, if you're long, be gone. Okay. Now, admittedly, after much struggle, much buying, much hope for the soft landing, we've come back up toward that price level. We don't trust the market still. We think it made a major top then. Even if it makes a marginal new high, it won't change our view. We think this market is topping. There's a problem with that for the Fed.
JP Morgan's analysts are notably bullish on gold and silver, projecting a rise to around $30 per ounce for silver in the fourth quarter of the upcoming year, following the upward trend of gold prices. What are your thoughts on the prospects of silver, especially about its recent performance compared to gold? Share your observations in the comment section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.